Okay, first video we need to tackle the cost. Like we need to learn how to compute the cost of an asset. And you would think this would be relatively straightforward, right? I mean, if I was going to buy a building and um, I was going to borrow money to buy a building and the building was $600,000, right? For the most part, the journal entry I think would just be building 600,000. And then notes payable would be the credit, 600,000, right? Not terribly difficult. The cost seems like it would be pretty easy. However, if you think about acquiring a building or even maybe building a building, there's more that goes into it than just the purchase price. There's all sorts of other things that would go into the acquisition of a building, right? You got to pay real estate agent and broker fees, and maybe you have to get the building valued. So as we go through different categories of physical assets, so if we think about physical assets, we have things like land improvements, right? If I do anything to the land to improve its value, land improvements, buildings, vehicles, equipment, and so forth. We're going to go through um, at least some of the more important or bigger ticket items in terms of physical assets over the next few slides and just talk about what we would include in the cost of acquiring or creating those assets. Okay, so first category, cost determination, right? It's obviously the purchase price, which is what I was just talking about. And then all expenditures needed to prepare the asset for its intended use. And this will make sense as we start talking about some of the specific assets, but it's like everything that we need to do to the machine in order to get the machine ready to be used. You can think of we don't even own the machine, but if you think about buying a machine and everything that you have to do to get that machine to your place of business, get it set up and ready, all of that would be considered the cost of the machine, right? All the expenses acquired and getting it ready for its intended use. Okay. All right. So let's go through some specifics. Machinery and equipment. Again, we were talking about the purchase price. Oftentimes, we'll incur taxes when we acquire machinery and equipment. The taxes would be included as the cost of the machinery. If I had to pay transportation charges, right? If I incurred or paid for insurance to have the machine sent to our location, right? I don't want the machine falling off the back of the truck and becoming damaged and then not having any recourse. I will get insurance for the traveling of the machine to my place. And then once the machine comes to our store, um, and if we have to like install, a a platform for the machine to sit on, the construction costs of the platform that would be included in the cost of the machine, right? And then if I have to train my employees, I could be a printing company and I have a new really sophisticated printer. And if I have to spend time training the employees how to use that machine, the training time would go into the cost of the machine. And then it could be, it's not good enough to install it correctly, train everybody, but I'm gonna want to like create or produce some test units, right? So maybe I'm gonna print some magazines and make sure the magazines look really nice. So anything that I incur, remember to get the machine ready to be used so that I literally turn the open sign to open and I start using it. All of those fees and costs that I incur up to that switch are going to be included in the cost of the machine. And it'll go on the balance sheet just as we had said. We would say, machinery and equipment. And if the sum of all of those costs were say 500,000, that would be the amount that I would put on the balance sheet for the machinery and equipment. And again, I could borrow the money for that particular machine. And again, it could be 450,000 purchase price, 20,000 in taxes, and 30,000 in installation. Right? The sum of those three would be my 500,000. Buildings, right? Again, same concept. I'm going to have two types of buildings. Either I'm going to purchase an existing building or I'm going to make a new building. Okay. But any of the costs associated with the construction of the new building would be included in the cost of the building. Anything that I pay for an existing building, that would go into the cost of the building as well. And then we have title fees. We want to make sure that the person selling us the building is the rightful owner, right? There's going to be transaction fees. We're going to have attorneys making sure the acquisition is straight and legal. We could pay taxes, property taxes, and so forth, and brokerage fees like real estate agents and so forth. But the sum of all of those costs, again, would go on the balance sheet for the line item buildings. Land improvements. And to me, it makes more sense to talk about land first and then land improvements. So land, again, it's the purchase price and then all of the things that we would incur to acquire land, right? We would do a title search, again, to make sure the person selling land is the rightful owner. We would pay real estate agent fees and maybe legal fees. Surveying, this would be if we bought land out in the middle of nowhere, we would want to know where the property lines are. A surveyor would come out and tell us precisely where our property lines are. And then property taxes, there are instances, just because I own land I have to pay property taxes. For me personally, I own a home in San Mateo and I pay probably $14,000 a year, probably $15,000 a year, just because I own a piece of land in San Mateo County. Okay. And if you acquire land and somebody hasn't paid the property taxes, when you acquire land, you might have to pay back taxes. And if you do pay the back taxes that somebody else hasn't paid, if you pay those at the time of acquisition, those would get included in the cost of land. Okay. One thing that's not in here would be land. I would say, what if you purchased the land and it had a building on the land and you didn't like the building, you wanted to tear it down, right? The cost associated with tearing down the building that you don't want on the land would go as a cost of land, right? Likewise, if you remove trees or if you had a tractor out and you leveled the land, all of that would go into the cost of land. And then, like we were saying, land improvements, right? Land improvements would be anything that you then add to the land that has value. So like if you purchased a big open space and you wanted to create a parking lot for your business, the cost associated with the parking lot, it doesn't go to land, it goes to land improvements. So you can think of anything related to land is the acquisition and destruction of anything existing that you don't want anymore. Then if you build anything up on that land, that would be land improvements. So driveways, fences, walkways, sprinkler systems, lighting systems, signs, all of that would be land. And then I think the thing they're trying to indicate here is land improvements are depreciated. However, land is not depreciated, right? If you think about if you pay $100,000 for a piece of property, you can walk on that piece of property, that land, for like 50 years, and it's never going to depreciate because you've walked across it for 50 years. Land is land. It does not depreciate. Lump sum purchases. Okay, this slide is way too complicated. So I'm just going to jump to my own example. Okay, so let's say that we purchase a home, right? So we buy a plot of land and on that plot of land, it's got a house. Look, a little nice front door. Okay, and let's say we pay, I don't know, keep it simple, $100 million. This is a big ass house on a big ass piece of property. Okay, we pay $100 million for this house and the land. Now remember, I have an asset section to the balance sheet, and I have cash, I have accounts receivable, I have inventory. We've gone over all this stuff now. I have supplies, and now I've got long-term assets, these physical assets. So I'm going to have long-term, and I'm going to have land and building. Okay? So the problem here is that I just paid $100 million for two things, land and a building. And so the question is, how much of the 100 million relates to land and how much of it relates to the building, right? If I were to go to the seller and ask the seller, hey, how much were you charging for the house or the mansion as opposed to the land? The seller's like, look, I have no idea. Like, leave me alone. Go figure it out. Right? It's $100 million for everything, and how much relates to the mansion and the house is your problem. Okay, so what we could do is we could go out and hire an appraiser, and we would say, hey, we just purchased this mansion. We paid $100 million for it. Can you tell us how much the mansion is worth, separate and apart from the land? So an appraiser goes out, and the appraiser comes back and says, hey, I figured it out for you. He says the mansion, the building, that is worth $700,000. Sorry. It is worth $70 million. Gotta get my numbers right. Okay. And the land is worth $40 million. For a total of $110 million. Okay. So the appraisal comes in at 110. And we're like, well, wait a second, right? I only paid $100,000. So do I put 70 million for the mansion and 40 million for the land for a total of 110? Can I do that? The answer is no, you can't. Okay. We have to put on the balance sheet the cost of acquisition, not what the value of the asset is, right? So we clearly paid $100 million for the land and the mansion, but it turns out it's worth a little bit more. And the important thing to remember is that what goes on the balance sheet is the cost of the asset, not the value of the asset. So we have to unfortunately undo this because that's not right. What I need to do is I need to say, okay, the total of both can only be 100 million. And how do I deal with that when 70 million is for the mansion and 40 million is for the land? What I can do is I can say, hey, you know what? I could figure out what percentage is the mansion relative to the total value of the assets. And if I open up my calculator, which will take me forever to open up, but I'm going to do it right now in real time, I would say, what percentage is 70 million divided by 110 million? And I'm coming up with, I'm going to round to 64%. So if the mansion is 64% of the appraised value, then I can assume that the mansion is 64% of the cost of the asset. So I would say, oh, 64 million. 64% of 100 million is 64 million. And then I could do the same calculation and I would come back and I would say, oh, you know what? 36%, right? 40 million divided by 110 million is 36%. And 36% of $100,000 is 36 million. That is the lump sum. That's how we would deal with the lump sum purchase of a basket of assets. And it could be a land and building. It could be furniture and equipment. It's going to be all sorts of different combinations. But the point is that we put on the balance sheet the cost of the acquisition, not the value of the acquired assets. Okay? There is, in this chapter, another concept that is referred to as revenue recognition revenue expenditure as opposed to capitalized cost. And it's way down towards the end of the chapter. But to me, it sort of makes sense to talk about it in context of the cost of assets, right? So the concept is distinguish between revenue and capital expenditures and then account for them, okay? So before I get into the slides, a revenue expenditure just means that it's something that I incur day to day. It's not something that goes to the cost of the asset. And a capital expenditure is something that relates to the cost of the asset, right? Capital expenditure, that we're saying that needs to go on the balance sheet. And whereas revenue expenditure, that just goes straight into the income statement. Yeah, so there are revenue expenditures. The revenue expenditures do not materially increase the plant asset's life or capabilities. We record them as an expense and they show up on the income statement. Sorry about that. Somebody came to my office door. Anyway, we were saying that revenue expenditures, they do not materially increase the plant asset's life. And therefore we treat them as income statement items, right? So if you think about, actually, let's talk about capital expenditures and then we can explain stuff. So a capital expenditure provides benefits for longer than the current period, recorded as an additional asset or addition to the asset account. And it's reported on the balance sheet. So I think of, like, if we're thinking about a vehicle, I think of revenue expenditures as oil changes, right? So an oil change isn't necessarily going to extend the useful life of a vehicle. It's just something that we have to do as a necessary evil, right? And then capital expenditures, this would be like a new engine, right? If I put a new engine in my vehicle, theoretically, it's going to extend the useful life of the vehicle, right? If I put a brand new engine in, it's going to run me another, hopefully 200,000 miles. So if I pay, if I pay $100 to have my oil changed, it's literally just going to be maintenance, repairs and maintenance expense, 50, and cash, 50. And then if I paid $20,000 to have my engine replaced, it would be vehicle 20,000 and then cash 20,000. But again, we are putting this on the balance sheet and we are putting this on the income statement. Difference between revenue and expenditures.